How did the world's most famous investor do in the first 4 months of 2020 in the crazy market and health turmoil? Buffett even had to cancel his famous annual meeting known as the Woodstock for Capitalists, where tens of thousands gather in Omaha for the chance to ask him a question. This year, appropriately, Buffett answered the questions online. Shareholders may wonder what he has been up to because he typically loves downturns in the market and he says to be greedy when others are fearful. He also came into this crisis well prepared, with over $120 billion of cash. However, from recent articles, it is not clear how greedy Buffett has been, and this video will look at how his portfolio did during this market downturn. On the surface, it may seem that Buffett underestimated the crisis. In early March, he also said this decline was nothing like 2008, but then the S&P 500 had some of its biggest declines in its history. The economic news has also been far worse than 2008. Jobs have been lost at a breathtaking pace, and a JP Morgan economist said the economy could contract at a staggering 40% in the second quarter. But there's reason to think that Buffett may have been somewhat cautious. His partner, Charlie Munger, said, "We are not playing," and he said, "We just want to get through this typhoon, and we'd rather come out of it with a whole lot of liquidity." This is in contrast to 2008, when Buffett went on a buying spree, buying Goldman Sachs, General Electric, and he even bought an entire train company. And we know Buffett didn't buy any elephants in the first 4 months of the year. He even trimmed some of his riskier positions and later exited airlines entirely. So how did Buffett's massive $248 billion portfolio do in the current market turmoil? Let's go through his biggest investments and whether you should buy these stocks. Let's start with his biggest investment. He has about 30% of his money in Apple, and it has been flat on the year. So this has actually helped his portfolio relative to the market. Apple recently reported its quarterly results, and they were excellent. Revenue was actually up despite all this turmoil. Buffett's average cost is about $141, and at the current price of $291, it means he's up over 100% in less than a few years on this investment, and he's made a profit of over $35 billion. I think Apple is still a decent buy for two reasons. One, I'm really excited that they're offering a lower priced iPhone for $400. In the past, Apple was reluctant to do this, but they're trying to transition to a model where people buy their headphones and wearables, and people use their services. Despite Apple saying its services division is separate from its iPhones, it's actually derivative of it, because if they don't make iPhone sales, then they're not going to make services sales. So if they have a lower price phone, they can get more people on its ecosystem, and hence more services and wearable revenue, and that's why I'm so excited about this $400 iPhone SE release. While this may hit into margins for its higher priced iPhones, I think overall it should help Apple have more long-term and stable revenue growth. Apple seems appropriately, if not a little underpriced, at a price to earnings ratio of 22. I personally wouldn't be buying Apple at this price because I think there's better opportunities, but I do think Buffett will continue to make some returns in this investment. Despite this bright future for Apple, I think Buffett may be looking to reduce the position a little bit. Right now it's about 30% of his portfolio, which is too much. We did see him sell 2% of this position at the end of 2019, and I'd expect him to maybe trim it down a little bit further in order to diversify a little more. It's possible Buffett puts some of this money in another tech company, or maybe he'll even put it in financial stocks, which are down huge right now. So let's look at some financial stocks. Buffett's heavily invested in them, and which ones are attractive to invest in. On the year, Bank of America is down 32%, American Express 27%, Wells Fargo 46%, JP Morgan 31%, US Bancorp 38%. So banking stocks are down huge. So are his banking stocks worth buying? Let's look at his biggest bank investment, Bank of America. BAC is down 32%, which is actually better than the KBW Bank Index, which is an index or an ETF that tracks the largest banks in the United States. Buffett famously bought into Bank of America in 2011. The idea came to him in a bathtub. This was during the time when the stock was only at $6. At the time, Buffett bought $5 billion of preferred stock, and he got 700 million warrants to purchase the stock at $7. Currently, his position is 950 million shares. So he bought his position at $7 and 250 million shares at about $30. The current price is $23, so Buffett is still up quite substantially on this investment. I think Bank of America is still a good buy at $23. It earned over $27 billion last year, or $2.70 a share, so it's a very cheap valuation. I believe banks should be trading at higher multiples. So JP Morgan, before the crash, showed in a presentation that banks have the lowest multiples out of all the industries. The fact that banks have had such low valuations for so many years can become a self-fulfilling prophecy where the market thinks banks only deserve low PE ratios. So PE ratio is just what is the price relative to its earnings. The thing is, even if these ratios remain subdued or low for banks for the foreseeable future, just think about it this way. Bank of America earned $277 last year. I think they'll be able to get back to that number next year or in a couple of years. And Bank of America has been growing their earnings at 15% over the last 4 years. So they've actually doubled their earnings since 2015. But let's just assume they can only grow at 3% going forward. That means in 5 years from now, they'll earn $3.20 a share, but you only have to pay $23 today. Meaning if you divide $3.20 over the price today, that means you'll have a yield of 14%. Think of how many things in the world you can actually get a 14% yearly return on. So I think it's pretty excellent to get a return of around 12 to 14% in a sector that's pretty well positioned for the future. So I like banks, JP Morgan, I like Bank of America, I like PNC Financial. I actually own JP Morgan and PNC. My biggest banking position is in PNC, so I think Buffett will get a return in almost all these banks. The one I didn't mention yet is Wells Fargo, where he still has one of his biggest positions. So he owns about $10 billion in Wells Fargo, and it's down about 46% since the start of the year, or $8 billion. Wells Fargo has seemingly fallen out of favor with everyone, including Warren Buffett. Buffett actually sold 55 million shares at the end of 2019, but he still owns a staggering 327 million shares, which was worth $17.4 billion at the start of the year. I actually think Buffett may have been selling out of Wells Fargo even during this market turmoil. We'll see this when he releases his positions by May 15th. The reason he may be selling even though Wells Fargo declined so much is because Bank of America and JP Morgan declined similar amounts. The main issue on why it's not so attractive to hold Wells Fargo right now is its expenses are very elevated at not a good time. So most banks are going to be lucky to be profitable this year given all the loan losses they're going to have to incur. However, Wells Fargo, its expenses are super elevated right now. So think about it like this. Wells Fargo has 260,000 employees compared to Bank of America's 208,000, even though Bank of America is a larger company. It took Bank of America years to shed its excess employees that it had accumulated before the financial crisis, and it's now a meaner and leaner firm. But inversely, Wells Fargo has become that bloated firm. Also, the issue is Wells Fargo has been picked on by the US government and the Federal Reserve. So its former CEO, John Stumpf, got a lifetime ban from banking. I think this is a little harsh because Wells Fargo took 6.1 million fees accidentally from 85,000 customers. This works out to only $20 per account. So the fact is the company bore the brunt of this critique, but I don't think Wells Fargo would initiate a fraud to steal $6.1 million because it was earning over $20 billion a year. So there were some rogue employees opening these accounts, and Wells Fargo's weaker internal controls allowed for this, but the company obviously wasn't doing this to take $6.1 million, as it's nothing compared to what they were earning. But the government has been blaming them, and they say they can't grow past $2 trillion in assets. Think about why this is a big issue. So think JP Morgan in their latest quarter, look how much their assets grew. Their assets grew by over $400 billion. Now think about this. Wells Fargo is another big bank, and their assets are going to be pushed upward as the Federal Reserve is just printing money. But as Wells Fargo's assets are pushed upward, they may even have to sell good assets because they need to get under that cap. That means that Wells Fargo may recognize losses. Wells Fargo may prove to be a scapegoat by government for everything wrong in the world for the next number of years. We don't know when the asset cap is going to be lifted. The CEO of Wells Fargo says it could be 2022 at this point. So Wells Fargo is going to be challenged for some number of years. I don't think it's wise to own it right now, and given that its expenses may be elevated for some years as it deals with all these issues, I could see why Buffett is selling out. If I only had to pick buy or sell, I would pick buy over sell, but I would rather own other bank stocks than own Wells Fargo. His next big investment is in Kraft-Heinz, which you may be surprised is actually down 6% on the year. So this seems like a lot given that Kraft-Heinz is really benefiting from this environment. Kraft-Heinz was a famous investment orchestrated by Buffett and this Brazilian firm 3G Capital in 2015. Berkshire Hathaway, or Buffett, now owns 26% of the company. However, Kraft has struggled with declining sales since the merger took place. And Buffett's partner, 3G Capital, has been reducing its stake. It actually sold 10% of its position last year. I know Kraft pretty well. I did a video on them last year, and I predicted a very grim future. However, the current pandemic is actually quite good for them, and it will be great if Kraft-Heinz can thrive because of this. But unfortunately, I think Kraft is still too risky to own. It has $32 billion of debt, and it only recorded adjusted EBITDA of $1.4 billion. So EBITDA is basically a top of the mountain view of what a company could make in the most ideal circumstances, assuming you didn't have any interest, taxes, depreciation, or amortization. So it's basically a maximum earnings number, and Kraft's adjusted EBITDA was actually lower this year than it was even the prior year, and its debt to adjusted EBITDA is 5.5 times. If you look it up, 5.5 is an extremely high number, and you only want to be at this number if you think you're going to go under this number very quickly, or if you have extremely stable growth, which Kraft doesn't have. They have negative growth. So I don't think you'd want to be in this business, and also worryingly, the company is still paying a 40-cent dividend rather than reducing its debt. So it's risky in my opinion. The other thing I don't necessarily like about Kraft is their organic sales only grew at 6% in March. This is such an extremely favorable time period for them. No one's going out to restaurants and everyone's eating at home. I would actually like to have seen their sales grow even more. I guess we'll see in Q2 because people might be at home for a longer time period, but you would expect if people aren't going out to eat that their sales would grow at 10 or 20%. So I think it could be a little concerning that their sales only grew at 6% in their first quarter. I showed also in a chart that Buffett has cashed out a lot of his money that he put into Kraft-Heinz, so he's not taking as much risk as you if you put in money today. So I would say don't buy Kraft-Heinz at the current price. I still see a grim future, but I think it would be great if the company can build its brand during this turnaround and people want to buy their products after. Another interesting position that doesn't show up on Buffett's equity list is Occidental Petroleum, but he actually invested $10 billion in preferred share last year, and because Occidental wasn't able to pay him his preferred dividend, they actually paid him $257 million in common stock. How did Buffett get involved in this company? Well, last year, they wanted to buy another oil company, Anadarko Petroleum, and Chevron had bid $50 billion. The Occidental CEO, Vicky Holub, took a jet over to Omaha, and she asked Buffett if he could help her with the bid. Buffett, in a 90-minute conversation, said, "Sure, I can help you out," and he gave her $10 billion of preferred stock that paid him 8%. According to newspaper articles, he didn't even consult his partner, Charlie Munger. So this was a very quick deal that Buffett made, and perhaps it will turn out to be smart, but it could turn out to be very dumb, and Buffett has credited Munger for helping him not do really dumb things in the past before.
And I've had a partner like that, Charlie Munger, for a lot of years, and it does for me exactly what Bill was talking about. Charlie, and so you have to calibrate with Charlie, though, because Charlie says everything I do is dumb, but but if he says it's really dumb, then I know it is. But if he just says it's dumb, I take that as an affirmative vote.
I do have to say that Buffett was very smart in the deal, so he noticed that if they couldn't make the $200 million dividend payment, that they could pay him in common stock. He also asked for the common stock to be at a discount, so he recently received $256 million in common stock instead of a $200 million cash dividend. So this sounds great, but one issue is Buffett can't really sell the common stock, because if he does, it would show that he basically has no confidence in the company. Buffett sort of has to hold the position in order to give banks and lenders confidence that the company will survive. On the other hand, this could be an amazing success for Buffett. He will basically be accumulating large portions of the company for essentially free right now. So if the crisis for Occidental lasts over the next year, Buffett could have 10% of the company that he would have accumulated, and he would still own his $10 billion of preferred stock. Personally, in our opinion, we're not sure if Occidental is a buy or not, just because the price of oil is so low right now, but it will probably rebound a little bit to $30 or $40. It could even rebound to $50 or $60. But at the same time, you really need to look through their finances to see if they could survive. A benefit is a big investor, Carl Icahn, has increased his stake. Carl Icahn tends to be quite smart and savvy, so if he's willing to put 10% of his money in right now to get elected to the board of directors, there may be upside in the future. But personally, I would need to research it very heavily in order to ensure that it could survive this downturn, and I'm just not confident enough to put my own money in it. Let's look at a few other key investments. The first one is the airlines, which have come up very publicly because Buffett was expected to be the airline savior, considering his large stakes in Delta, Southwest, United. Southwest, the best airline, is down 42%. United Airlines down 66%. American Airlines down 58%. What's funny is in 2001, Buffett said he would never invest in airlines again. Yet in the last few years, he couldn't help himself. Also, in the beginning of March, he said he would not be selling his airline stocks as a result of the pandemic, but we later learned at the end of the month he sold some Delta and Southwest. So was Buffett right to be fearful when others were fearful? And should you be greedy when Buffett and others are fearful? I think Buffett's sale was actually correct. For one, the airlines do not have great financial metrics. One metric to look at is the Z-score that predicts bankruptcy. So the Z-score basically adds up 5 different financial ratios, and the higher number, the better. As can be seen, Southwest is the only company somewhat safe in the airline sector. The Z-score has shown to be correct about 72% of the time, so it's a ratio that's worth looking at in terms of looking for survival. The industry has a lot of risk. Delta says they're burning $100 million of cash a day, and they're hoping to get to $50 million by the end of June. Even Southwest is burning $30 million of cash a day. So if we do a quick calculation and Southwest lost $30 million of cash a day for 6 months, that would be $5.4 billion or $4.4 billion after tax, or about $10 per Southwest share. If we do a quick valuation and we see that Southwest was trading at $56 before this crisis, and now you expected them to lose $10 a share, plus they earned $4 last year. So as a shareholder, you should be lowering them at least $14 lower than what you would have valued them before this crisis hit them. So the maximum price you would want to give even the best airline like Southwest is $42, and you can see Southwest price is about $30. But I would argue there are more risks. For one, it's hard to know how long this crisis will last. Southwest said they're in an unsustainable position right now. So if this crisis lasts longer, this could depress earnings in year 2 and year 3. Also, Southwest may be forced to fire a lot of employees, and then it could take a while to rebuild the capabilities of its workforce. So for all these reasons, even buying the best airline at $30, hoping it will go to $42, seems like too much risk to me. If I go through the S&P 500, the worst performing company index, I could see companies, let's say like PVH Corp, a clothing company that is down more than Southwest. It's down 53%, but not all its revenue has gone to zero. The company still operates in China and it sells online. So their revenue has gone down about 70%. So I would say it has a lot less risk than Southwest, but it is down more. So I'd rather own that. I just don't think there's sufficient risk reward, and Buffett agrees too, and I don't really find any of them attractive at these prices, but perhaps if Southwest goes to 15, I would find it attractive. I think Buffett made the right play selling his airlines, and it seems in mid-March, Buffett did call the 1-800 number that he talked about in the past.
I went into US Air. I bought a preferred stock in 1989. As soon as my check cleared, the company went into the red and never got out. I mean, it was really dumb. I mean, I've got an 800 number I call now whenever I think about buying an airline stock. I call them up any hour that, fortunately, I can call them at 3 in the morning, and I just dial it and I say, my name's Warren, I'm an aeroholic, and I'm thinking about buying this thing, and they talk me down. I mean, it takes out.
Finally, let's just go through the last major stocks of Buffett. So Coca Cola is surprisingly down about 17% this year. I think it still trades at too high a multiple. As consumers reduce their consumption of soda, revenue has been choppy since 2015, but I don't think it's a terrible investment at this price. Buffett also owns other positions like credit card companies, Visa and Mastercard. They issue credit cards, and then when you make a transaction, they ensure your transaction is processed. I see Visa and Mastercard having risk as blockchain develops. I think people will be able to pay for things on their phone and use different payment networks much easier than now. Right now, it's nearly impossible to not use Visa and Mastercard because everyone pays with plastic. Visa and Mastercard will definitely benefit for the next few years as people switch from cash to cards and people buy online more. But I'm thinking in 5 years from now, Visa and Mastercard will be very challenged. We can see overall he lost 18.5% this year. This may seem bad because the market has only lost about 12%, but you have to remember the S&P 500 has been pulled up by a few tech names like Amazon is up 30%, Microsoft is up on the year, Apple is flat. If you look at the average S&P 500 stock, so how the average performance has been, the market is actually down 18% and the median stock is down 16%. So Buffett has not done as bad as it looks. Okay, so I hope you guys enjoyed Buffett's portfolio review and how he did this quarter. Please leave a like and subscribe if you enjoyed this video and you want to see more portfolio reviews.